Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Here's a really special treat. Sitting next to me in studio in New York, Mark Gurman, Bloomberg Chief Correspondent on Global Technology. I worked here for 13 years, and I don't think I've ever seen you in person. You're usually on the West Coast, but you're real. He's 40.
He was here last week as well, so I don't know what's happening. We get it 2 weeks in a row. Oh my goodness,
I was off last week. Okay, so obviously we're talking about this news that Apple is going to add about 20,000 U.S. jobs. To your understanding, how did this come about from Apple?
Good question.
Okay, so during the first Trump administration, Tim Cook, other companies were obviously very worried about tariffs, right? And so their strategy was, we can try to make a deal here. What does Trump want? Trump wants his supporters to know or see that he's bringing jobs back to the U.S., bringing money back to the U.S., bringing manufacturing back to the U.S. Apple doesn't want tariffs on the phone, and it wants to keep as much phone manufacturing in China as possible. We don't have to get into the reasons why. There's a ton of them, okay? So you have these two sides, right? There is a universe in which both parties can get exactly what they want. It's like a trade, right? And so you saw that strategy in full form this morning. Trump, for months, obviously, the second administration has been talking again about bringing back jobs, has been talking again about moving things to the U.S., has been talking again about extra tariffs on goods from China. So Apple comes out with a press release this morning. We're investing $500 billion in the U.S. over the next 4 years, which, by the way, that's Trump's term, right? He just started. Okay. 20,000 new jobs, AI server manufacturing with Foxconn in Houston, doubling our manufacturing fund from $5 billion to $10 billion, setting up a manufacturing academy like a school in Detroit. So you ask yourself, what's really going on here? They want Trump to know that they're investing heavily in the U.S., and since we're doing that, we don't want tariffs. And so the spin to Trump is that we're doing this because of you. The reality is somewhere in the middle. The reality is that Apple has been investing as part of its business operations in the U.S. from the very beginning. The reality is in 2021, Apple announced a $430 billion investment in the U.S. The reality is that Apple hires 4,000 R&D employees a year in the U.S. anyways. So what's actually new here? To be fair to both Trump and Apple, there is a bit of an acceleration. So their typical spend under the 2021 U.S. investment plan, $86 billion annually. Okay? The new plan, $125 billion a year annually. So you're getting a $40 billion jump under Trump, and you're moving from 4,000 people on the R&D side hired annually to 5,000 people. So incremental, sure, but definitely an acceleration.
Okay. 1 minute. Is there a quid pro quo here? Do you think Apple actually already has a deal with President Trump that they will be exempt from tariffs?
No.
Okay.
But Tim Cook went to Donald Trump's office last week and presented this to him, said, we're going to do this because of you, man. Oh, and by the way, we don't want to pay tariffs. And Trump knows that. Trump doesn't care about giving Apple a reprieve on tariffs. He's happy to do it. And he's happy to do it and tell people that he did it because Tim Cook is investing $500 billion during his presidency. He can go back to his supporters, his base. He can go back to Congress. He can go back to the world and tell them that the world's biggest technology company, the most famous company in the world, is investing $500 billion, its biggest investment commitment ever, right, because of me. And for Trump, that's awesome.
Yep.
And for Tim Cook, not having to pay tariffs is awesome. And I think that's good enough to get some sort of tariff reprieve. And by the way, let's say Trump doesn't give them a tariff reprieve. Who cares? Right? I was doing this anyways if I'm Tim Cook.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Happening right now in Hollywood, Florida is the BMO Metals Conference, a metals and mining conference. I used to go back in my day when I was covering gold. It's really cool. You get to talk about metals. And we're lucky enough to talk now to Kathleen Quirk, President and CEO of Freeport-McMoRan Copper and Gold. Kathleen, it's a sincere pleasure. If I take a look at your stock versus the copper price, you usually track each other. In the last couple months, that hasn't been the case. Is that a demand issue? Is that a supply issue? How do you explain that?
Alix, it's good to be with you, and you need to come back to Hollywood. This is a great conference. In terms of the stock price and the copper price, we've seen somewhat of a disconnect in recent weeks. I think there's some concern in the market about China and about the trajectory of copper prices as we go forward. So there's some risk that people are discounting the current copper price. But as we look at the situation and look at copper demand going forward, copper, as you know, is the metal when it comes to electrification. And we're looking ahead at all of the build out that needs to take place in energy infrastructure, not just in the US, but around the globe. China's already been doing it, but we're starting to see it taking place in the US and other places. It's very copper intensive. And we see a situation where demand for copper is going to be faced with a secular uplift, opportunity for growth in copper unrelated to cyclical drivers. So we're actually really bullish about where copper is today and what the likelihood for increases are for the future.
Kathleen, I think so far every S&P 500 CEO on their conference call has been asked about tariffs and the impact on their business. What will a rising tariff regime potentially mean for your business?
We're following it very closely. We're looking at it, trying to understand exactly what degree of tariffs will be imposed. No one exactly knows what it will be, although companies are preparing for it. Freeport operates all over the world, but we have a significant operation, significant presence in the U.S. And actually, we're integrated in the U.S. We not only have mines that produce copper, but we also have a smelter that processes our copper. So we don't have a need as a company to import copper from other countries. Copper is imported into the U.S. Because there's not enough current supply of copper to meet the demand. But from a micro standpoint, as we look at what the market is pricing in for the impact of tariffs, actually the U.S. price of copper, when you look at where U.S. Commodity prices are today and copper prices are today, the U.S. price is something on the order of 25 cents per pound higher than copper that's priced on international markets. So actually for Freeport, we're actually receiving for the copper that we sell in the U.S., we're actually receiving a premium to copper that we sell out of, say, South America or out of Indonesia. So it's actually right now in the short term a benefit for Freeport, several $100 million a year potentially. But the thing that we're watching, and the thing as we talk to investors and other business leaders, is the impact, the potential impact of tariffs on global growth. China is a big consumer of copper, consumes likely above 50% of the market. And so an all-out trade war could impact global growth. It could impact copper prices. It could impact, manifest itself through a strong dollar, which also impacts commodity prices. So we're watching those macro issues, but in terms of the on the ground today, we are getting a premium for the copper that we sell in the U.S.
We have about 30 seconds, and then you have to run to an investor meeting. So in 20 seconds, what do you think the copper price is going to do this year? If we take a look at the LME, are we looking at 10,000, 12,000?
It's very difficult. We're not in the business of predicting short-term prices, Alix. As you probably know, we're in the business to control our costs, to invest wisely and prudently. We have a very positive long-term outlook for copper. You can't replace copper today for $4 a pound. We need higher prices in the future in order to invest in the business and generate the growth and demand, the growth and supply to meet the expected growth and demand. So we're very positive on the long term, but the short term is difficult to assess.
All right, Kathleen, we appreciate it. Please come back when we all have more time. We'd love to break down some more stuff with you. Kathleen Quirk is president and CEO of Freeport-McMoRan Copper and Gold.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. We go now for a broader view. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments, and she joins us now from Houston. Victoria, buy the dip has been the norm. Then there's been chattering that buy the dip won't last and that we're on borrowed time for that. Where do you stand on that?
Yeah, I think it depends, Alix, on the size of the dip that we're looking at. When we have small pullbacks that happen just in regular volatility due to the uncertainty around whether it's going to be Fed policy or whether it's fiscal policy, and those are going to be things where I'm not sure you want to jump in and start buying a lot of names. But I do think that as we go through the first half of this year, we probably will have a chance as there will be a more significant pullback. I'm not saying we're going into recession by any means, but I do think you're going to see things start to pull back, probably led by maybe weaker earnings as we get the first quarter earnings of this year. We see those slow down. We see the labor market slow down, consumer spending slow down. That, I think, then is going to be your opportunity to go in and find those areas within the market where you have seen sectors start to struggle and maybe form a trough and on their way back to have upside trends. That's where you'll want to go in and start buying.
So, Victoria, you mentioned earnings were about a little more than 80% of the way through the fourth quarter earnings there. What are your takeaways from those earnings and maybe even from the guidance?
Yeah, so, Paul, surprisingly, earnings have been really good for the fourth quarter. I mean, we're looking at 15% earnings growth, 5% revenue growth. I think energy is really the only sector where we have seen negative growth as a whole for the sector. So really strong there. And I thought we would have started to see some of the effect of the higher rates that we had throughout 2024. I thought we would see some of the effects of the labor market weakening start there, but maybe it's getting pushed in to the first quarter earnings as tariff concerns pulled forward a lot of elements into the fourth quarter of 2024. So strong earnings, and I think that's why you saw probably the S&P hit a high last week, because that animal spirit is still running high due to the earnings and that support to the economy. But that's probably going to start fading away. We saw it at the end of last week. I think we'll see some more of that over the coming weeks.
Yeah, and speaking of, this is from Bloomberg Intelligence, just talking about earnings. Apparently, companies that guided higher on profit and sales have outperformed the S&P by 6.7% within a day of posting results, the most since 2020. I found that to be really interesting. I hadn't noticed the disparity effect there. So, Victoria, though, despite earnings, we have seen rotation into European equities. Do we think that actually continues, or the U.S. exceptionalism theme reigns?
Yeah, I'm not surprised that we've seen this switch. I mean, I know all morning long we've had the conversation around valuation, right? And if it's still something that people are looking at, clients aren't asking about it. You've talked with Bob Dahl, my CEO, Mike Wilson earlier this morning talking about that. But valuations in Europe are much lower than what we're seeing in the markets here. So I think as investors say, where can I get maybe a bigger bang for my buck? And you're looking at that valuation number, Europe makes sense, especially in the financials. Financials are doing well well globally. So it gives you an opportunity to get in there. And you also have to start thinking from an FX perspective, what that's going to look like. Are you going to see continued rate cuts from the ECB? And what does that mean for the euro? And what kind of carry trade we're looking there? Obviously, the yen carry trade, people are starting to watch once again. So I think there's a lot of different factors, but it wouldn't hurt to kind of dip your toe a little bit internationally, even though I still think globally you'll see the U.S. over time continue to be the strongest economy.
Yeah, I'm glad you brought up international investing, because I'm just looking at an email I got from Torsten Slok from Apollo this morning, talking about the market capitalization weight, how the gap between the U.S. And the rest of the developed world is widening, so that concentration in the U.S. equity markets relative to the rest of the world is just getting more and more. To what extent is that a concern?
Well, concentration is always a concern for us, Paul, because you don't want to, to use the old phrase, you don't want to put all your eggs in one basket. What we're starting to see in the U.S. is some of those elements where all that concentration was, those Mag 7 names, you're starting to see pullbacks in those names. And hopefully we will see things broaden out. But it really hasn't been as strong as a lot of people thought it would be when you're looking at the other 493. I mean, you look at the S&P making its high last week, but the advanced decline line for the New York Stock Exchange did not meet it and go to a high like that. We're still only seeing about 53% of the S&P above its 50-day moving average. So we're not seeing that broadening out that we like to see for a sustainable move higher in the markets. We'll continue to watch that, but we really want to see that concentration start to diminish a little bit and have more of a widespread uptrend in these names.
Does any of that include, say, small and mid caps?
Well, we would hope so, right? Small and mid caps is really kind of what will tell us, yes, we have found our footing. We're feeling better. We like what's going on. But look, we've seen yields move lower, even though inflation expectations have moved higher. So to me, that's saying, okay, wait, these are growth concerns that we have right now. If growth and the concern over a lack of growth is what's pulling yields down, that's not going to be great for small and mid caps. And we also have to look at the fact that, we're hanging in around that 440, 450 level on the U.S. 10-year. We've got about a third of all corporate debt in the U.S., small, mid, and large cap, coming due over the next 5 years. That's going to be a concern for those small and mid caps when it comes to refinancing. So we'll have to see what happens there. But for right now, I think we continue to wait on some of those small cap names until they get some better footing and we see the economy on its way back up.
Victoria, 30 seconds. What's the fixed income call here?
Well, look, we've been doing barbell strategies in our fixed income portfolios, really wanting to capture some of the higher yields on the shorter end as we think the Fed stays higher longer. That keeps those short rates higher. And we have seen inflation push the longer end up as well, although over the last couple of weeks, there's been a flattening. So I think maybe lock in a little bit of these rates on the longer end, take advantage of the short end, and we'll let the belly of the curve adjust to the volatility that we've seen.
Victoria, thank you so much for joining us. Always appreciate getting a few minutes of your time. Victoria Fernandez, Chief Market Strategist for Crossmark Global Investments. She's based down there in Houston, Texas.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Musk federal worker order divides Trump administration. Elon Musk demanded that over 2 million federal employees submit 5 bullet points accounting for the past week, but he's getting some pushback from some of the folks that lead these departments, like the FBI, like the Secretary of Defense. So let's check in with Max Chafkin. He covers all this stuff. He does all the Elon Musk stuff for Bloomberg News. Is this kind of the first cracks, Max, potentially from Elon Musk with his heavy-handed Doge?
I'd say it's the most significant cracks that we've seen. We've seen like little maybe micro fissures or something before, but in terms of you have Musk over the weekend for sending this email out or having this email be sent out and then tweeting essentially nonstop about how important it is, how easy it is, how anyone who doesn't respond, doesn't deserve their job. Meanwhile, as you said, important parts of the federal government either saying publicly or semi-publicly, like in an all-staff memo, that they should not respond to these emails. That is significant. And that, I think, you really see, first of all, the extent to which, there are probably going to be limits to what Elon Musk can do, no matter what Donald Trump says. And also, as you see these sort of stronger personalities, people like Kash Patel, the new director of the FBI, get into their positions, they are also going to be power centers, and they are going to potentially push back or even challenge Elon Musk at times.
But wouldn't it all just take President Trump to call up the naysayers and be like, nope, what Elon says goes?
Yeah, it's not totally clear what Trump wants here, although Trump did do a Truth Social message essentially saying, I want Elon Musk to be even more aggressive.
Exactly.
And Musk has taken that as permission, but Trump has not explicitly endorsed this. My sense is, anyway, that Trump wants Elon to be the bulldog here, right? And perhaps...
But also take the heat at the same time.
Exactly. Maybe move the Overton window or whatever. Make some of these more extreme measures, extreme reforms. Attacks on the quote unquote administrative state, as conservatives call it, more palatable, more politically palatable. While as you said, Alix, not attracting the heat himself, allowing Musk and also his cabinet appointees to sort of fight it out, even in public.
Max, in addition to being a Bloomberg Businessweek senior reporter, you're also the co-host of Elon Inc, the podcast about Elon. The people you talk to with this podcast, is there any kind of consensus about how long Elon Musk and President Trump will coexist peacefully before maybe these two large egos kind of start butting heads and it may blow up to some extent?
Early on in the Trump presidency, you saw people who had sort of covered Trump or close to Trump world more skeptical about Musk, okay. Right? See the fact that Trump has over the years had these people who kind of come into the center of his world, often these business figures who briefly have a run and are then forced out or end up in public disputes. Anthony Scaramucci, the short-lived press secretary, being kind of the most famous example of this. I have been, I'd say, more optimistic that Elon Musk and Donald Trump will last, and that's partly because Elon Musk has showed again and again that as much as we think of Musk as having this big ego, he has been willing to kind of play second fiddle to Trump. We saw that kind of relationship on the Sean Hannity show last week, where he had Trump kind of cutting in at times, essentially telling Elon, "Oh, I'll speak for you." So he has been more willing than usual to sort of play second fiddle to Trump, to embrace Trump kind of fully rather than trying to create any distance. And then the other thing is Musk has real leverage over Trump, more leverage than any of these other business guys have. He was the biggest donor in the 2024 cycle and is a potential mega donor in the midterm. So as Trump looks to kind of rein in, contain, influence a Congress that is potentially going to be very difficult to influence, Musk is probably the most important asset that he has, because Musk can say, hey, if you don't support this nominee, if you don't support this budget, I am going to primary you, and that is going to be a credible threat. And we've seen Musk do that already. I think we're going to see him do more of that.
And just to the point, we were talking about it in the newsroom earlier, that like all the negative vibes are on Musk right now, not Trump. Even if they believe the same thing, that's like a really lovely foil.
Absolutely, yes. I think you're right, and I think that Trump has, it's hard to know like what he's doing, what's definitely strategy and what are just tactics or whatever. But it does seem like one of the results of this approach is that Musk is becoming more unpopular for some of these things, and Trump is kind of not necessarily touched by it, right? People are mad at Musk for sending these aggressive emails or for firing federal workers or for defunding charities that they know about. They're not necessarily taking it out on Trump. I guess the risk here for Trump is that Musk becomes just so controversial.
Yeah, it's too much.
And he's also just, as we saw during the appearance at CPAC, he's potentially erratic.
Mm-hmm.
He potentially, on any given day, any given hour, he can make himself the story. And again, once you start getting to more tense things, for instance, negotiations over the budget that are coming, or in Ukraine or whatever, you can imagine that stuff creating lots of risk and problems for Trump.
All right, Max, really appreciate it. Really wonderful stuff. Max Chafkin, Bloomberg Businessweek senior reporter, co-host of Elon Inc Podcast.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.